Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome to Aviation Intelligence Weekly. I'm Sarah, and today we're diving deep into Southwest Airlines Q1 2026 10Q filing, released April 23rd. With me is Mike, our aviation industry analyst. Mike, we've got $2.01 billion in revenue and $330 million in operating income to dissect here.
Thanks, Sarah. If we reduce this filing to one sentence, it's this. Southwest is executing a fundamental business model transformation from a no-frills carrier to an ancillary revenue generator while managing the operational complexity of that pivot during a capacity-constrained environment. Based on this filing, Southwest Airlines is operating in a structural reset phase. They've abandoned core elements of their historical low-cost model and are rebuilding their revenue architecture in real time.
That's a bold thesis. Let's test it against the evidence. Starting with material changes. What shifted significantly versus what we'd expect from Southwest historically?
The most telling change is in their revenue composition. The filing explicitly states that the increase in passenger ancillary sold separately in first quarter 2026 as compared to first quarter 2025 was due to the company's initiative to implement new ancillary products, bag fees for most fare products beginning May 28, 2025, and operating assigned and extra legroom seating for travel beginning January 27, 2026. This is Southwest abandoning its bags fly free differentiator that defined their brand for decades.
And operationally, what does that mean for their cost structure?
Here's where the complexity multiplies. They took delivery of 10 Boeing 737-8 aircraft, but retired 13 aircraft. 8 Boeing 737-700s plus 5 sold aircraft. That's net negative capacity growth while they're trying to implement assigned seating and premium cabin configurations. From a unit economics perspective, they're betting they can generate higher revenue per available seat mile through ancillary fees faster than their constraining capacity growth.
That's a high-wire act. What's the causality chain if this strategy hits turbulence?
If passenger acceptance of the new fee structure disappoints and load factors drop below historical norms of 80-85%, Southwest loses both the volume game they mastered and the premium revenue they're chasing. Operating leverage turns negative and margins compress below the 10-12% range that low-cost carriers typically maintain. The filing shows they're committed to $4.1 billion in capital commitments for 2026 aircraft deliveries, so they can't easily reverse course on capacity.
Let's examine what management is actually saying about this transformation. What signals are you picking up from their commentary?
The tone is notably cautious about external factors, but confident about internal execution. Management states that air travel is also significantly impacted by general economic conditions, the amount of disposable income available to consumers, and changes in consumer behavior, unemployment levels, corporate travel budgets, global pandemics, extreme or severe weather, and natural disasters. That's a comprehensive list of concerns for a company betting on premium revenue streams.
Any specific language that caught your attention?
Yes, they explicitly acknowledge that these factors have created, and may continue to create, significant volatility in the company's financial results. The phrase may continue to create suggests management expects ongoing volatility, not a return to their historically stable operating patterns. They're essentially warning investors that the transformation period will be bumpy.
From a seasonal perspective, how are they positioning this?
They maintain that demand for air travel has historically been greater, and therefore, revenues in the airline industry tend to be stronger during the summer months and peak travel periods. But here's the key. They're implementing premium seating and bag fees during what should be their strongest demand periods. If these initiatives fail during peak season, they have limited runway to course correct before the traditionally weaker fall and winter months.
That brings us to financial red flags. Mike, what's concerning you in the balance sheet dynamics?
The debt structure is the primary concern. They're carrying $4.93 billion in total debt, against $3.33 billion in cash and equivalents. That's a debt to cash ratio of 1.48x, which for an airline in transformation mode provides limited cushion. Airlines typically need 2-3x cash coverage during major operational changes to handle execution risks.
How does that compare to historical airline industry norms?
Most major carriers maintain cash positions equal to 20% of annual revenue during stable periods. Southwest's $3.33 billion against quarterly revenue of $2.01 billion suggests they're running at about 41% of quarterly revenue in cash, which annualizes to roughly 10%. That's below industry comfort levels for a company undergoing major strategic shifts.
What's the causality chain if liquidity tightens?
If the revenue transformation disappoints and cash generation weakens, they face pressure on their $4.1 billion capital commitment pipeline. Either they delay aircraft deliveries and fall further behind on capacity growth, or they tap credit markets at potentially higher costs during a period of operational uncertainty. The filing shows they have interest rate swap agreements on $750 million of their debt, converting fixed to floating rates, which increases their exposure to rising rate environments.
Let's talk about their risk disclosures. Any new concerns flagged by management?
The filing reveals ongoing Boeing delivery delays due to manufacturing challenges and FAA certification delays for Boeing 737-7 aircraft. This isn't just a Southwest problem, but it hits them harder because they're a single aircraft type operator. When Boeing stumbles, Southwest can't easily substitute aircraft from other manufacturers like mixed fleet carriers can.
How does that impact their transformation timeline?
It creates execution pressure. They're trying to reconfigure their revenue model while dealing with constrained aircraft availability. The filing shows they're taking Boeing 737-8 deliveries, but waiting on Boeing 737-7 certification. From a fleet planning perspective, this forces them to optimize revenue on existing aircraft rather than growing their way out of the transition period.
Any other operational risks worth highlighting?
Fuel cost volatility remains significant. They terminated their fuel hedging program in 2025, and the filing states that approximately $108 million remained in AOCI related to these previously closed positions, with approximately $86 million to be recognized in the remainder of 2026 and $22 million to be recognized in 2027. They're essentially taking $86 million in fuel hedging losses this year while operating with no fuel price protection.
Now let's examine their liquidity position more closely. Beyond the cash and debt figures, what's the balance sheet telling us?
The balance sheet structure shows they're managing through the transformation with adequate but not abundant liquidity. The $3.33 billion in cash provides operational flexibility, but remember, airlines burn cash quickly during demand disruptions. Southwest's historical advantage was operational simplicity that kept cash burn low during stress periods.
How does the new complexity change that equation?
Assigned seating, premium cabins, and bag fee processing all require additional operational infrastructure and staff training. These initiatives increase fixed costs before they generate revenue. From a cash flow standpoint, they're investing in complexity while hoping to harvest higher margins. If demand softens, they can't easily strip out these new cost layers like they could with their previous simplified model.
What about their credit facility availability?
The filing doesn't detail specific credit facility terms, but they note no cash collateral posted or received as of March 31st, 2026, related to their derivative positions. This suggests they're maintaining adequate credit relationships, but the real test comes if they need to access those facilities during the transformation period.
Moving to segment analysis, though Southwest operates as a single segment, what geographic or operational insights can we extract?
The filing confirms they operate scheduled air transportation in the United States and near international markets as a single reportable segment. This simplicity is actually strategic. They're not diluting management focus across multiple business lines during their transformation.
How does that single segment focus impact the transformation execution?
It's both a strength and a vulnerability. The strength is unified execution. Every route, every aircraft, every employee is focused on the same strategic pivot. The vulnerability is no diversification. If the ancillary revenue strategy fails, they can't offset with strong performance in other segments, like network carriers can with international or cargo operations.
From a capacity allocation perspective, what are they prioritizing?
The net reduction of 3 aircraft in Q1 while implementing premium seating suggests they're prioritizing revenue optimization over growth. This is classic late cycle behavior, maximizing returns on existing assets rather than expanding capacity. But they're doing it during a structural reset, which creates interesting dynamics.
Finally, let's talk about what traders and investors should monitor going forward. What guidance did management provide?
Management was notably sparse on forward guidance. They state that operating results for the 3 months ended March 31st in 2026 are not necessarily indicative of the results that may be expected for future quarters or for the year ended December 31st in 2026. That's essentially telling investors not to extrapolate Q1 results, which suggests significant variability ahead.
What specific metrics should we track to validate or invalidate your structural reset thesis?
3 key metrics. First, ancillary revenue per passenger. If their bag fees and premium seating don't generate at least $25 to $30 per passenger annually, they're not replacing the revenue lost from their historical competitive advantages. Second, load factors. If they drop below 80% while implementing these changes, it suggests customer resistance. Third, unit costs. If cost per available seat mile rises faster than unit revenue, the transformation is failing.
What would prove your thesis wrong?
If load factors hold above 85% through Q3, while ancillary revenue per passenger exceeds $35 and unit costs remain flat, our structural reset thesis is wrong. They'd be successfully executing a premium transformation without sacrificing operational efficiency. The counter thesis would be that Southwest is evolving into a hybrid low-cost carrier that captures both volume and premium revenue.
How should we think about valuation in this context?
At current operating margins of 16.4%, based on this quarter's $330 million operating income on $2.01 billion revenue, this equity trades like a mid-cycle expansion operator, not a structural reset story. If the transformation succeeds, those margins could expand further. If it fails, they revert to single-digit margins typical of commodity carriers.
Revisiting your core thesis. Does the evidence support Southwest operating in structural reset mode?
Absolutely. The abandonment of bags fly free, implementation of assigned seating, premium cabin configurations, and acceptance of operational complexity all represent fundamental departures from their historical model. They're betting the company on becoming a different type of airline. The $4.1 billion capital commitment and willingness to operate with constrained liquidity during this pivot confirms they're all in on transformation rather than incremental evolution.
Mike, thanks for that comprehensive analysis. For our listeners, remember this is educational content, not investment advice. Always consult your financial advisor before making investment decisions. We'll be back next week with another deep dive into aviation earnings. Until then, keep your analysis grounded and your insights sharp.
Thanks, Sarah. The key takeaway: Southwest is no longer the Southwest of the past decade. Whether they become the Southwest of the next decade depends on execution over the next 4 quarters.